I actually think that we'll probably grind a little bit higher in September, but I think there's a couple of things we need to look at. First of all, earnings season is over, and 25% earnings growth for the S&P 500 really pushed stocks higher. So we're going to have a quiet period. So we're not going to have that kind of floor on the market where earnings have been going up. The Fed meets later this month, and they're going to raise rates more than likely. And if they actually indicate that they're going to raise rates at the end of the year in December, right now it's about a 60% probability. If that looks like it's going to go higher than that, I think that could cause a bit of a headwind. We potentially have $200 billion of tariffs next week, even as early as next week against China. That's problematic. And we have the midterm elections coming up in about 2 months. So I think despite the higher momentum for stocks, there are some things that could derail it. So I think investors definitely need to be wary of these.
There are certainly still some question marks. Mark, what do you think about what the bond market is indicating? We continue to be a bit worried about this inversion of the yield curve. When you're looking at equities and you're looking at the signals from the bond market, mixed signals?
Yeah, it does feel like the bond market and the equity markets are really sending contradictory signals to investors today. Bond yields have declined so far in August. That's despite rally within the S&P and other equity markets in the United States. But we do see signs of trouble brewing on the horizon, and the performance of the equity markets on Wednesday was particularly troubling to me. We saw the S&P rallying even as Turkey and Argentina were in the midst of a meltdown. So, to me, that disconnect between what's happening in U.S. assets and international assets could be a cause for concern.
Why should there be a connect, though, Mark? Why should there be a connect if it's widely viewed that there is no transmission mechanism of that contagion? I mean, the U.S. markets are reflecting what's going on in the United States right now, and that is strong economic growth, strong corporate profits, right?
Well, oftentimes you will see the Fed tightening start to hit the weakest hands across the markets, and Italy, Argentina, and Turkey have certainly been exposed as very weak hands so far this year. But one of the reasons the equities did so well last year was that synchronized global growth story. So to the extent that we see trouble spots within other spots across the globe, that's going to dry up dollar liquidity. So, we think it's going to be the impact of the Fed tightening that eventually flows to U.S. shores.
Darin, pick up on the international point. I note that you made a bet on international developed markets last year. So far, it hasn't really paid off, but you are holding on the theory that it is going to pay off imminently.
Yeah, we saw the synchronized global recovery last year. Emerging markets up 37%. International developed markets did quite well. This year, we've seen a disconnect, as you mentioned. So the dollar's strengthened. It's weakened some of these foreign currencies. The trade tariff talks have put some pressure on these markets. And what we've seen is emerging markets down 7% this year, the S&P at roughly 10. You have a 17% delta. There's starting to become some valuation disconnects that make emerging markets, for instance, become very attractive. So if you throw out Turkey and some of these other countries and you focus more on China, India, some of the bigger markets, there's really some good opportunity now. Is now the best time to enter? That is hard to say, but I think for the next year or two looking forward, there's some really good opportunities, and rebalancing and selling some of your winners and actually moving back into some of these underperforming areas, albeit scary, is probably a good thing to do right now.